Hey traders, this is Blake Morrow with Trader Summit, and I have a very special guest today. I have Adem Tumerkan, and he is the editor and founder of Speculators Anonymous. Good to see you, Adem.
Great. Thanks, Blake. It's always a pleasure.
Yeah, it's really nice to be with you. And, I know we planned this talk a couple weeks back, and I thought we'd talk about something a little bit different, but because of recent events, I think we need to hit on the banking sector, right? We got a lot to talk about today.
Yeah. It's definitely been the talk recently with everything going on.
So what do you make of, well, let's start with America's issues. Let's talk about Silicon Valley Bank, and what are your thoughts about that bank and maybe the banking system in general here in the US?
So yeah, banking in America, I guess. So it's become very little context. It's become very concentrated over since 2000s, right? We've seen the top 5 or 6 big banks now control roughly 50 to 60% of the assets. And a lot of it had to do with Fed policy changes. They started doing interest on excess reserves after 2008. And that's basically, so when you're a bank and you have reserves, you put them in like the Fed funds market or you hold them. And back in the day, pre 2006, they never paid interest on it. So there was more counterparty monitoring, because if you're a bank and you were running low on reserves, you would go on the Fed funds rate. Was like, it's still a private, even though the Fed sets the Fed funds rate, it's still a market rate basically. And that's like the rate other banks will lend to each other to cover the reserves. If they made more, so for instance, if someone made more loans that they than deposits, and they were running low, instead of going out and selling CDs or whatever at a higher rate, they would just borrow from the other banks who didn't make as many loans that day.
Yeah.
And to the banks, it was good because obviously if you just have idle reserves sitting there, it's kind of a tax. You want to do something with that money. And it kind of created like this counterparty balance in a way, because banks would look at other banks and say, hey, why are they selling CDs to investors or money market funds at a much higher rate? Usually when you and I know, when a bank starts selling a ton of assets like SVB, if they have to sell assets or if they have to raise interest rates to attract deposits, it's kind of a red flag. It kind of amplifies the problem because people start looking at them. There's actually a good paper I read recently that banks raising rates above the market or the Fed funds rate to attract capital, they have poor health in the future. And it makes sense because there's something's wrong. That's why they need to pull the money in. So yeah, but then after 2006, long story short, Fed started doing interest on excess reserves. Since then, interbank lending between banks has plunged. It used to be like 200 billion a day. Now it's like 60. Like because now they're getting paid to hold those reserves. So the Fed effectively became the borrower of first resort compared to what it was supposed to be, the lender of last resort. So it's just created a lot of like, it's basically turned banks, in my opinion, to like black boxes. And like we were saying with SVB, so after 2020, the central bank and the fiscal side, they pumped some $5 trillion worth of stimulus, but bank deposits ballooned. And you saw banks like New York Signature Bank and SVB, their deposits compared to the average bank went up. It was like parabolic. So when you're a bank and you get all these deposits, you have to do something with it. You can't just have it sitting there. You owe interest on it. It's a liability, right? So they had to go buy assets. And then, yeah, we saw these banks, they went and they bought treasuries. And it's actually interesting because SVB, I think it's one of the first banks, if not the first bank, to actually fail, not because of its asset side, because their assets aren't that bad. They have like mortgage-backed securities, treasuries, they have like decent assets, but their depositors were the problem. And when you're in Silicon Valley and you depend on funding tech startups, because if you're a bank and when you extend a loan, you're creating a deposit. And usually you want that deposit to stay in your bank because then that gives you more deposits. Sure. So these venture firms that weren't making money, tech startups, right? They're not profitable. They have to continually get more loans. So if SVB is making a loan to company A and they were putting money in Silicon Valley, like in their own bank, they'd be writing a loan, but then they'd be putting that deposit on their own balance sheet, which gave them more deposits. But as we've seen over the last year, venture capital money slowed to a trickle. Like tech startups, all these companies, so these companies, they weren't making new loans, which wasn't new deposits for them. And then deposits started leaving. And not to mention, it was very concentrated. So a little regional bank in Cleveland, let's say it's harder to get 6 million people with, 100 grand, 200 grand to go pull their money out, where you just have like a Peter Thiel or a couple big names just say, hey, take our money out. And then right there, you're drawn down.
That makes a lot of sense. So what I'm gathering from you then, Adam, is that it's not it's going to be more of an isolated event for SVB versus like a bigger banking sector issue.
Yeah. So so last week when I was in a Twitter space, I was telling people, I was like, I think this is very similar to like long-term capital management. The Fed's not going to technically bail them out, but they're going to get the banks together, say, hey, what are we going to do about this? The FDIC is now involved in everything. And they're going to just basically try to absorb their loan book. We saw the Fed open the discount window, which is essentially meaning short-term, usually less than 1 year. All their banks that are having liquidity issues can, because all these banks have a ton of treasuries and mortgage-backed securities. And as you know, I know there's a thing called mark to market, which in banks, if you're a bank, so what it means is if you hold to maturity, you don't have to realize those losses. So we know the Fed's been raising interest rates, bond prices have fallen. But if you hold them until maturity, you don't have to show the realized losses. You just hold them, you get the interest plus the principal back later. But if you have to sell in the open market, then you have to realize those losses. And then it's like a cascade effect, because obviously then everyone's going to see you're a bank and your asset base is down like 15, 20%. So the Fed is opening the discount window at this point to say, hey, we're going to give you money at par, basically. You don't have to like write anything down, don't have to sell it. It's kind of like a repo. And then we'll give you the liquidity. And then when things settle, we'll just swap it back.
That makes sense. Okay, well, let's shift gears and talk a little bit about Credit Suisse. So what are your thoughts there with what's happening in the European banking sector?
Yeah, Europe's been, the euro dollar, everything's been Europe's been, especially Credit Suisse over the last year, the strong dollars really hurt them. I think if I remember right, I was reading a paper by the Bank of International Settlements, the BIS. There's some like $65 trillion in short dated currency swaps. It's like 5 times more than bank capital bases. Wow. And I'm sure Credit Suisse, clearly they've had a lot of that because they need liquidity. The stronger dollar is putting pressure on them. And now they also were a big buyer of US equities, if I remember right. They're one of the bigger buyers. And with everything kind of down, now they're, insurance companies and all across Europe and banks are just kind of struggling with the stronger dollar and higher rates in the US. It's just creating a bunch of outflows. And yeah, we've seen, Credit Suisse has been under some pressure. So I wouldn't be surprised. It reminds me of like, remember back in like 2014, 15, when like Deutsche Bank, everyone was like saying like, I think Credit Suisse is kind of, the European crisis. So I wouldn't be surprised if something, further amplifies. Banks are just black boxes. You don't really know you can be the best analyst ever. And I used to do this, right? You look at these balance sheets and everything, but you never really know what they have.
Good point. Okay. Well, it's definitely created a lot of volatility in the markets. And originally when we reached out, when I reached out, we were going to talk a little bit about China and, the China reopening and how you were seeing it, because I hear two different stories. I hear that, it's China reopening. You're going to see a resurgence in their in maybe inflation, but also in spending from the retail sector, and you're going to see another growth boom. But on the flip side, you look at the data and it's not all that great. So in your view, how are you seeing China and this reopening and how the economy is doing in general?
Yeah, so I've been thinking since like 2018, China's kind of hitting their Japanification wall. And just to give people some context, Japan after 91 blew up and they've just kind of been like lulling along for 30 years. Like their real GDP per capita, it was one of the fastest rising through the 60s to the 91. Now it's flat. If anything, it's been flat for 30 years now.
Okay.
So there's no growth. There's just nothing there. It's a dead economy, more or less. And I think China, Europe following the same thing. Actually, a lot of countries in the world, their real GDP per capita are still below 2008 levels. Like Australia, I think Canada just eclipsed it, or it's like right back to where it was. But it took 14 years to get there. So the American real GDP per capita is the only one really rising. China's went up, but it's at like 12,000, their real GDP per capita. And it's just for the second largest economy in the world. To put it in context, Japan's the third largest economy in the world, and their real GDP per capita is still in like the mid 30,000s. So China has a really bad consumption problem. I guess to put it simply, yeah, like you just said, they're not consuming what they make. And we see that in their trade data. That's why they're running huge current account surpluses. Then that's just in economics, when you produce more than you consume, you have to export the rest, right? And if there's no other country, like if America wasn't running deficits, let's say, and no one was there to absorb this glut, you'd see unemployment and deflation just like ripple through, because you're gonna have all this piled up stuff. And China's just aggressively stimulated their supply side, and they're still doing so, but it's just amplifying the problems they already have. So they have an underconsumption problem. Same with Europe. Germany's a huge exporter, Netherlands too, and they have some of the lowest shares of consumption to GDP. And it just makes you wonder, like, how much more pressure can America take? America has to be the one that, if these countries are forcing their own surpluses, and China doesn't, they keep the yuan cheap or artificially cheap. It's like a currency mercantilism. So they dissuade imports and try to boost their exports. They don't have any social safety nets. It's like marginal. So the average Chinese has to save more, to depend on more, future protection or whatever. Where in America, you have the 30-year mortgage, which is a huge subsidy. You have like welfare, social security is obviously a huge one. So you can see the difference. Like, America does everything to drive demand, while China does everything to promote saving. Yeah. And then all that excess savings has to go somewhere. And since America is the reserve currency and we have an open capital account, we have to absorb it. And then when we absorb it, we issue bonds, because they don't want to just sit on a bunch of cash. They want some return on their money. So America has to chronically run these bigger deficits, and I don't see it. And it puts America in a fragile position, because we've seen businesses aren't investing as much. I was looking at a recent Bloomberg piece, and net private business investment, it's fallen from it was like 5-6% in 1980. It's like 2% now. It's like businesses aren't investing. So all that savings has to go somewhere.
Yeah.
Especially compounding interest. Einstein said it's like the eighth wonder of the world. And when you have the wealth of the top 1% and the foreign reserves just compounding so much faster than GDP, it's flooding into the household sector. And we've seen that, like the US consumers, last data from the New York Fed showed $17 trillion in household debt. But the problem is household debt isn't sustainable long term, right? You will hit a wall. And China's isn't much better. China has a really bad household debt ratio to GDP. It's like 60% too. So they're already really leveraged. The only problem is America does things to kind of stimulate our consumer, to like let them refinance, do everything to keep consumption going. But China doesn't. And I think we've seen it. I know, yeah, like you said, a lot of people were saying China reopening was going to be really inflationary. To me, I think it's, the South Korean exports to China have been horrible, like negative 40%, right? Terrible. Their retail sales last month was negative. I think it just hit expectations for January, February. They ran their largest current account surplus on record in January to February. So, it just shows they're not consuming, and the government's trying to stimulate it more, the supply side, but that's just going to make the problems worse.
Wow. Okay. So now, being that we're at the Trader Summit and we're talking about trades, how would you, as an investor, position yourself with what you just told me regarding China? Where should we be, and what should we be looking at?
So yeah, it's tricky with China, because you don't really know, and it's really dependent on foreign inflows and what they're doing with their own monetary policy. But when you see China so China is trying to step on the gas. They're coming out of COVID. I think it'll be deflationary for the world, because it'll bring on more supply, but for their economy, it could stimulate growth on the supply side. But I would say, like, I'm looking at like calls on the FXI or something, if you're feeling speculative. It had a pretty good run the last few months, mainly because of a weaker dollar and reopening narrative. But then we kind of saw that all fall apart. Obviously, the dollar's stronger than it was back then, and now, you know, there's fears that America is going to pivot, which I'm assuming they'll do sooner than later, just because of all the, I mean, the yield curve in America is already uninverting, but it's not uninverting because growth and inflation, right? It's because the 2-year has dropped so much back to zero that it's kind of uninverted, which really happens pretty much before every reset. That's why the yield curve is so important, because when it uninverts, it's not because growth or anything picks up that lifts the longer end of the curve.
Yeah.
It's the opposite. So I've been long bonds. That's been really great lately. I just loaded up on TL. Yeah, I was telling this to Dale too. Like, I just really felt long bonds, they were really oversold, in my opinion, of TLT and stuff in October. And then now, when the rate was at like 4.3, 4.2, now rates are at like what, 3.4 or something. So all it takes is one black swan to, you know, change everything. And
or maybe like 2 in a week.
Yeah, 2 in a week. Yeah,
2 in a week.
Now it's going to
have
ripple effects. And another problem with the U.S. bank. So I know I kind of like U.S. more as like a speculation, like the regionals. If you find some like banks that are, because I think you're going to see an outflow of deposits from more marginal banks, more smaller banks into the big banks, which is going to be a problem for the smaller banks, obviously, because that's not what they want. But I think that's just going to be the concentration of the wealth. I mean, I think JP Morgan just saw their deposits increased rapidly, and I'm not surprised. You know, banks are going to pull out from these and go to the other ones, but then that leaves that bank with their counterparty risk. Like, you know, who knows? Like, it's a black box. Like, who knows what pulling all those deposits out would do to these banks? So I don't think we'll see the end of this banking thing for a while, but I do think if you can find some big names in the sell-off, you know, I was looking at like Charles Schwab, just, you know, banks that basically could handle it and you know, keep things going, I guess, at this point.
All right. Well, that's some great insights, Adam. Now, I always enjoy meeting with you. It's fun. It's great to hear your insights. Tell us, the traders, how they follow your work more closely. What's the best way to follow you?
So you guys can just check out my website, speculatorsanonymous.com, or just on Twitter at Radical Adam. That's usually where you can find me posting stuff pretty frequently.
And everybody should know Adam is ADEM. So just make sure that yeah, catch that one. Hey, Adam, it's been great chatting with you. I look forward to catching up with you sometime in the, you know, first end of the first quarter of this year or so. Thanks for joining us, and make sure if you like what you hear here, make sure you give Adam a thumbs up, subscribe to the channel so you don't miss any of this exclusive content. Have a great day.
Great. Thanks, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.